What if I told you the trade relationship that once defined global economic stability is now unraveling, with repercussions that could impact your grocery bills, tech gadgets, and even your job? China, America's largest trade partner for years, has slashed $690 billion in imports from the United States. This decision is sending shockwaves through global markets and signaling a seismic shift in the economic dynamics between these two superpowers. This decision is rooted in a combination of geopolitical tensions, trade disputes, and China's growing push for economic independence. It marks a critical turning point in U.S. China relations. For years, these two nations have been deeply intertwined, with China serving as a top consumer of U.S. agricultural products, energy resources, and technology. However, as the trade war intensifies, and both countries vie for dominance on the world stage, this move highlights an escalating rift with far-reaching implications for industries, workers, and governments worldwide. But why has China turned its back on the U.S.? Is this the end of American dominance in global trade? And what happens when the ripple effects reach your front door? The United States is losing its largest customer as China slashes purchases of crops, chips, and LNG. Once America's largest buyer, China has now turned to Brazil, Russia, and Europe, threatening the $575 billion trade relationship that once stood at the core of global economic balance. The U.S. and China together account for over 40% of global GDP, making their trade relationship one of the most critical in the world. In 2022, bilateral trade between these two nations hit $690 billion, with China serving as a key buyer of American agricultural goods, semiconductors, and energy resources. However, here's the existential problem. China's imports of U.S. goods have been declining steadily since 2018. According to the U.S. Census Bureau, Chinese imports of U.S. products dropped by 17.7% in 2023 compared to pre-trade war levels. This is devastating for sectors like agriculture, where China once purchased nearly 60% of America's soybean exports. Dr. Chad, a senior fellow at the Peterson Institute for International Economics, warns that this is not just about trade figures. It's about how deeply interconnected industries are. Losing China as a buyer sends shockwaves through supply chains, employment, and innovation. The unraveling of this economic relationship can be traced back to the U.S. China trade war, which began in 2018. The Trump administration imposed tariffs on $360 billion worth of Chinese goods, and Beijing retaliated with tariffs on $110 billion worth of U.S. exports. Agriculture, technology, and energy were among the hardest-hit sectors. According to a report by the National Bureau of Economic Research, during the peak of the trade war, U.S. exports to China fell by nearly 20%. Beijing didn't just retaliate, it restructured its approach. The Chinese government started diversifying its supply chains, turning to Brazil for soybeans, Europe for technology partnerships, and Russia for energy. In an op-ed for the Financial Times, economist Yunding stated that the trade war accelerated China's push for self-reliance. This wasn't just a temporary response, it was a long-term strategy. The idea behind tariffs was to pressure China into buying more U.S. goods. Instead, they made American products more expensive and less competitive on global markets. For instance, soybeans, one of the largest U.S. exports to China, saw a price drop of over 18% in 2018, as Chinese buyers pivoted to Brazil. Between 2018 and 2020, U.S. farmers lost an estimated $4 billion in export revenue due to tariffs. Agriculture has been the hardest-hit sector in this economic downturn, largely because of its reliance on China as a key buyer. In 2022, China purchased over $36 billion worth of U.S. agricultural products, down from $45 billion in 2017. Soybeans, corn, and pork were among the most affected commodities. The share of China's soybean imports from the U.S., the top American export to China, dropped from 40% in 2016 to just 18% in 2024, according to Chinese customs data. For farmers in the Midwest, this decline has been catastrophic. Farm bankruptcies in states like Iowa and Nebraska increased by 23% during the peak of the trade war, according to the American Farm Bureau Federation. Many family-owned farms, already operating on thin margins, were forced to shut down. John Heisdorfer, an Iowa soybean farmer and former president of the American Soybean Association, described the situation as dire. Losing China as a customer isn't just a loss of revenue, it's a loss of stability. It's hard to plan for the future when your largest buyer disappears. Brazil has stepped into the gap left by U.S. farmers with strategic precision. In 2022, Brazil exported a record 87.6 million metric tons of soybeans to China, capturing over half of the market share. This dominance wasn't accidental. Brazil benefits from lower production costs, favorable trade agreements, and a currency advantage. Moreover, China has invested heavily in Brazilian infrastructure, including railways and ports, to streamline the transport of agricultural goods. China and Brazil have developed a symbiotic relationship. Brazil provides the raw materials, and China provides the capital to move them. Marcelo Vieira, president of the Brazilian Agribusiness Association, noted that these investments have solidified the growing economic ties between the two countries. The economic fallout from reduced agricultural exports extends far beyond the farms themselves. Entire rural communities depend on the success of agriculture. From equipment manufacturers to logistics companies, when farms lose income, so do the businesses that serve them. A University of Illinois study found that every $1 lost in farm income results in a $287 reduction in local economic activity for rural towns in the Midwest. This means fewer jobs, school closures, and declining populations. Megan Nelson, an economist at the American Farm Bureau Federation, warned that without a robust farming economy, the social fabric of rural America is at risk. China's efforts to reduce its reliance on U.S. farm imports are part of a broader strategy to bolster its food security. Key moves include halting purchases of U.S. agricultural products, diversifying supply chains, and developing domestic production capabilities. For example, on August 5, 2019, China halted purchases of U.S. agricultural products in retaliation against tariffs imposed by the Trump administration. By 2023, China had approved several genetically modified crops to boost domestic yields and implemented its first food security law, aimed at achieving absolute self-sufficiency in staple grains. These policies have placed China in a better position to withstand potential future tariffs on Chinese imports. They also raise the prospect of further retaliation targeting U.S. agricultural goods. The semiconductor industry, often referred to as the new oil, has also been significantly impacted by the trade war. Semiconductors are the foundation of modern technologies, from smartphones to artificial intelligence. China is aggressively working to close the gap in semiconductor production, marking a significant escalation in the technological Cold War. In 2023, U.S. chip exports to China fell by 14%, according to the Semiconductor Industry Association. This drop is not merely economic, it's strategic. China's Made in China 2025 initiative aims to produce 70% of its semiconductors domestically by 2025. To achieve this, China has invested billions in research, development, and manufacturing capabilities. Dan Wang, a technology analyst at Gavco Research, explained that China views its dependence on foreign semiconductors as a vulnerability. This shift threatens the survival of U.S. tech companies, which have already reported revenue losses due to reduced Chinese demand. For instance, Qualcomm saw its China revenue fall by over 15% in 2023. Energy is another critical area in which China has reduced its reliance on the United States. In 2021, the U.S. was a leading supplier of liquefied natural gas, LNG, to China. By 2023, those exports had declined by 25%, according to the U.S. Energy Information Administration. Following the Russia-Ukraine conflict, China deepened its energy ties with Russia, signing a 30-year agreement for natural gas imports via the Power of Siberia pipeline. Additionally, China secured long-term LNG deals with Qatar, including a $60 billion agreement signed in early 2024. For U.S. energy companies, this decline in Chinese demand represents a significant loss. The Energy Information Administration reported a 22% drop in LNG export revenues in 2023. With ripple effects across the broader energy sector, China's diversification strategy is fundamentally altering global trade dynamics. By reducing its dependence on the United States, Beijing is building stronger ties with emerging markets and regional partners. For instance, China's trade with Brazil surpassed $50 billion in 2023, making Brazil its largest trading partner in South America. Jennifer H. Mann, a senior fellow at the Council on Foreign Relations, warned that the United States risks being sidelined in global trade if it doesn't adapt. China is positioning itself as the center of a new trade order. Trump's tariff war, while intended to punish China, may have unintended consequences for the U.S., including higher costs for consumers and strained relationships with allies. Higher prices on imported goods could reduce consumer spending, potentially affecting jobs in the retail sector, and contributing to inflationary pressures in the U.S. economy. As the U.S. and China continue to compete for dominance, the outcome remains uncertain. The U.S. is facing the challenge of adapting to a new global economic order, while China is strengthening its position by accelerating its path to self-reliance. The question remains, is this a trade war the U.S. is destined to lose, or can both nations adapt and innovate to thrive in a rapidly changing global economy? The stakes could not be higher. The outcome will shape the economic landscape for decades to come, determining the balance of power in trade, technology, and geopolitics.